This presentation is a little bit tongue-in-cheek. You know, what is with the hedge fund industry? It definitely gets a lot of press, and we hear about how they have their struggles. But in reality, they're doing okay. But we'll talk about some of the issues they face and how some of you might be able to play a role in addressing some of those needs. If we look at the last 20 years or so of my history, I can tell you from personal experience that things have changed for hedge funds. When I started back in the 90s, I worked for a fund that was one of the first algorithmic hedge funds in the world. And I remember one day we got a letter from BGI that said, "Congratulations, we've just identified that you're one of the top 3 investments in the world. You have a 18% annual compound rate of return over 30 years, and that ranks you number 3 in the world." They wouldn't be getting that letter today. In fact, most hedge funds wouldn't. After the late 90s, assets under management soared and returns went down. And they struggled to really keep up with idea creation and generation. The research and development departments had a hard time keeping up with the influx of money, and they resorted to copycat strategies. And as we look at some of the data, we'll see how similar they all are to each other, and they appear to be kind of doing a lot of the same things. And so wherever you see a problem, there's usually an opportunity as well. So at Cloudquant, we think this is a great opportunity to bring data scientists and SaaS platform for doing institutional quality research together to democratize the opportunities to come up with investment ideas that we think can change the industry. And so we're going to talk about how that works. So at Cloudquant, we're democratizing the search for alpha. Alpha is kind of a name in the industry that we use for returns. So, what is Cloudquant? It's the world's first free, cloud-based, high-frequency trading simulation platform. Anybody can go use it. It's on the web right now. You can log in and build a trading strategy. And we've written it in such a way to kind of create an easy button for people to create trading strategies. And we've written it in such a way where we depend on a lot of pieces of the Anaconda stack so that people who are already doing data science find it very familiar. And so our mantra is, you create it, we fund it, and then we'll profit together. Because what we want to do is we want to license these really great ideas from whoever came up with them, and we want to share in the profits with them. And we hope that this increases the throughput of the research department so that the hedge fund industry as a whole can actually generate returns that are more comparable to what the passive investment strategies in the world are generating right now. So let's look at some hedge fund performance in the last 6 or 7 years. So what we have here is an index of hedge fund returns from HFR, the Hedge Fund Research Group. And we can see that the equity hedge funds, which are typically long-short funds, they might be long 60% stock, short 40%. They usually are net long the market. They have a little beta exposure. And so you can see the red line near the group at the bottom is the best performing, and it seems to have something to do with SPY, which of course is the S&P ETF. So you see the beta exposure there. The cumulative return of the hedge fund index is minuscule compared to just being long the market in a passive index strategy. TLT is a long bond ETF. You can see that does quite well as well compared to the hedge fund indexes. And then the SPY plus TLT, which is I think purple, you can see that that's kind of a hedge fund substitute strategy. That's, some people call it kind of the poor man's pension fund, but it's actually a really good strategy in the sense that if you look over the last 6 years, it looks like it has a very smooth equity curve in comparison to the hedge funds. So most of the hedge funds have a 2% management fee. They take 20% of profits, and they're having a really hard time competing with some of these passive indexes. It really comes down to being able to generate enough new ideas. And just like any of the engineering problems that you all are facing in your daily lives, A research group at a hedge fund or some other investment manager is no different. They get up every day. Some of them don't have quite the skills that all of you have, but they work hard every day trying to put, to make more money for their clients and for their company. This is just showing that the variance of the returns for SPY, the hedge fund substitute, and TLT are a little bit bigger than the indexes, but that's because we're looking at an individual investment, and the index is an average of a lot of hedge funds. But actually, I'll also point out that the mean of the distribution of those is a little bit higher because they make more money, which we'll see here. So if you look at the annual returns and the daily returns and some of the other statistics, you'll see that equity hedge funds have made 3.2% on average annually over this time period, whereas just being long SPY, you would have made 11.8% annually. But it's not just about returns, it's also about risk-adjusted returns. What kind of risks are you taking? We use Sharpe ratio at the bottom for measuring risk-adjusted returns. And what you'll see is that the passive investment in SPY is actually, on a risk-adjusted basis, second to only relative value arbitrage. Relative value arbitrage is companies like Carlson Capital who have fundamental analysts who really work hard, digging into financials, calling companies, staying up late at night, listening to conference calls, trying to figure out which things are over and undervalued. They do something that probably is very difficult to automate, and I'll make a prediction here that I don't think that it's going to be anytime soon that that's automated, because there are so many different aspects to the job that maybe in the long run we can figure out how to turn it into a data science problem, but there are too many conversations and things like that that have to be had on the phone that it's really hard to get it into a data set that you can actually model. So I just wanted to point out that relative value arbitrage looks like it's on a risk-adjusted basis a reasonable strategy, although the rates of return are a paltry 1.9% annually on average. This is just looking at the 12-month rolling Sharpe ratio for the various strategies. And I guess what you see is once in a while, you'll see one of the strategies do a little bit better than the passive strategies, but usually they're below that in their Sharpe ratios. The risk-adjusted returns are lower. And this is a similar type analysis. So why are the returns lower? Well, there was some work done, I guess I read about this back in the 90s, but there was some work done by a guy named Doyne Farmer and a number of other people out in Santa Fe who built, simulated markets, and they looked at what happens when you have deterministic opportunities in a market, you have structured some time series, and you start allocating money to various agents who take advantage of that structure. And one of the things, they showed a lot of interesting dynamics, but one of the things that they showed was that by allocating too much to a particular strategy that was taking advantage of this market structure, they started to destroy that structure and make it chaotic. So it became unpredictable when you over-allocate to a particular thing. So I think the point here is the hedge fund industry had some good ideas initially, and they took in a lot of money and they allocated a lot of money to it, and it took the returns down in part because they're probably destroying the very structure they're trying to exploit. So the only way to really address that is to come up with new ideas. In order to do that, we need more throughput through the research departments. If you look at every single different type of hedge fund, you see that they're very highly correlated with each other, even though auspiciously, if you looked at their description of what they're auspiciously doing as a hedge fund, they sound like they're doing totally different things. But very clearly, this isn't causal, but it's certainly correlated, and it seems very suspicious that they're probably taking advantage of the same kinds of opportunities. So we did some factor analysis just for kicks to see what kinds of factor exposures, which are not typically the things that you try and make money off of because they're hard to predict, but what kinds of factor exposures these hedge fund indices were exposed to. So we did a typical model that's found in finance called the Fama-French model. And we just regressed the returns of the indexes against these standard factors that you would learn about if you were getting an MBA, for instance. And we see that we explain a significant portion of the variance, but not everything, but a significant portion with these factor exposures. The macro index hedge fund group is comprised of people who are looking at global trends, currencies, fixed income, exchange rates, things like that. They don't have as much exposure to these equity factors, so it makes sense that their R-squared is lower. Relative value arbitrage is typically market neutral, so they'd be long $1 worth of stock and short $1 worth of stock. So it makes sense that they wouldn't have as much exposure to some of these things as well. Their R-squared is lower. I posited that if we looked at them versus each other in addition to these factors, that we might see that we could explain more of the variance, because I think that a lot of them are doing all the same thing, types of strategies. And so we, in fact, kind of show that the R-squared goes way up when we regress them against each other. And so we see, the equity hedge, for instance, the R-squared is 84%. That's pretty high. And so that kind of supports our thesis that people move from firm to firm. They take the idea that they had at the old firm. They instantiate a new version of it. They have a hard time coming up with new ideas. Research departments aren't that big. Even at the biggest hedge funds, they don't have that many people working in the research department. Wouldn't it be great if everybody in this room could be working on, coming up with ideas in their spare time? How many more great ideas would we get with the number of people that are in the crowd? So in conclusion, based on our study, we feel like we were able to show it's pretty likely that much of the alpha generated by hedge funds is not captured by the typical factor exposures, but it's driven by these unseen common strategies that's shared among the hedge funds, because they share a common pool of talent. They hire people from different firms, and they teach each other how to do the strategies. And it also suggests that they're basically leveraging the same kinds of ideas in slightly different flavors. How can we change that with Cloudquant using the Anaconda stack? Well, first thing we can do is invite anybody who wants to get access to it to use it for free. Make it free so that there's no barrier to entry. People who would never get a chance to interview for a big hedge fund job can now go online and come up with their own hedge fund strategy. We allocate capital ourselves, and we love dealing with individuals who are creative and who have their own ideas about things. We provide alternative data sets that you would normally only find at big hedge funds, and it's all free. And this is just an example of what the code looks like. It's just Python. It's anybody who's using Anaconda today would be able to jump on there and say, hey, this is what I expect it to look like. It's just like the other stuff I do every day. So this is just a snapshot of one of the workbenches we use for writing scripts. Another thing that's happening is machine learning is changing how research is done in the industry. I had a conversation with some folks I worked with at Merrill Lynch a long time ago. I was on the cash trading floor, on the program trading desk at Merrill during the internet bubble. And at the time, I believe it was the largest equity trading floor in the world. I worked with some guys who were a little bit older, and they asked me, what do you think of AI and machine learning strategies, how they'll impact the market? Do you think they're going to change how the market works? And I tried to figure out how to explain it, but this is how I'd explain it. I think that if you look at the types of predictors that you come up with using machine learning, and the types of predictors you come up with using the trial and error approach that we used before machine learning became popular, what you realize is you're coming up with the same rule sets, maybe slightly more complicated, but mostly just the same. You just arrive at them more quickly. And so I told them, you don't need to be afraid of anything. The only thing that you need to be aware of is that the research departments are becoming more productive. They're getting more work done more quickly because they don't have to search trial and error basis, doing backtest after backtest, looking almost manually, if you will, for the answer. They have tools that allow them to arrive at the answer more quickly. So we had a strategy that came to us. We hired somebody who is a fundamental analyst. He's actually a CPA, and he's been doing fundamental analysis his whole career for the last 15 or 20 years. He's using a big data set that a lot of you in the crowd would know exactly how to manage and manipulate. He was bringing it into a spreadsheet because he was not a programmer. And he was doing all of his analysis using conventional ordinary least squares regression to do some prediction on revenues. And this was his strategy over the recent past. He actually made about 20% annually over the course of about 5 years, which is not a bad track record given the hedge funds we just looked at. But he had a lot of volatility, as you can see, a lot of ups and downs. It wasn't necessarily a smooth ride. We introduced him to Cloudquant, and within about 6 weeks, he was able to write scripts in Python after learning the language and work on doing some machine learning on the same idea that he'd been looking at for years. And this is what he came up with. So this involves about 1,500 trades, I believe, over the course of, let's see how many, 400 trading days it looks like, 409. He only has 2 or 3 inputs into the model. So he's got a couple degrees of freedom, but not too many. And this is what the performance improvement looked like. And this is a perfect example of how a data science background can improve the speed and the quality of research being done at hedge funds and investment companies. So we started out with a Sharpe ratio, which we saw before, is the risk-adjusted return of 0.52, and it increased to 2.87. That's almost a factor of 5 improvement in risk-adjusted return. The actual returns went up from 14% to 43%. Pretty impressive improvement. And this is trading live money, right? So this is an example of one of the reports we generate with Cloudquant. This gives you some diagnostics to analyze your strategies. And anybody who runs backtests on Cloudquant can download this and see the same report. It's the same tool we use internally for our internal hedge fund. In here we see kind of a further analysis looking at the daily win rate percentage on the left going from, I can't read it actually, but it looks like probably 45% to around 52% or 59%. That's a pretty big improvement as well. And it looks like the average profit to average loss ratio went up from 1.33 to 1.66. These are pretty significant improvements. And for somebody who, granted, he's got a master's degree, he's got an MBA, he's a CPA, but to come in without any programming experience and within 6 weeks be able to generate results like this and improve a strategy he's been working on for 5 years, to me is astounding. It's great. And it speaks to the power of data science and machine learning and the Cloudquant tool. These are some of the sources I used for this presentation. Just wanted to reference. So let's talk about some recent data about how it's going for some of the nascent artificial intelligence funds and how they compare to the traditional hedge funds. There's not too many of them, but we do have some initial data for the last 5 years as to what's going on. We'll start out by talking about how non-machine learning empowered systematic trading has been becoming more popular over the last 20 years. And here we see that actually systematic macro strategies have outperformed discretionary macro strategies over that time period. And it looks like, by a factor of 2 to 1, they actually outperform. Interestingly, discretionary equity strategies, which are like the fundamental relative value strategies, outperform the systematic equity strategies. However, the risk-adjusted returns for the systematic equity, if you look at the appraisal ratio on the bottom of 0.35 versus 0.25, suggests that the risk-adjusted returns for the systematic equity strategies is still superior, even though the average rate of return is lower. So that's an interesting situation where it looks like humans do things better still, and probably will keep doing things better. But maybe you can control your risk better and get a higher risk-adjusted return on the systematic side. These are just some panel regressions showing factor exposures. The thing I wanted to get to here is if we look at the systematic macro strategies that are run, basically algorithms like the firm I initially referenced that I worked for back in the 90s, where everything's algorithmic, it's based on simulation and backtesting, and there's not a lot of human intervention. if you look at their exposure to various factors, you see that they don't really generate their returns by being exposed to factors. The factor, the explained variance due to factors is very low and trending around 0. Whereas if you look at the discretionary macro, it looks like the discretionary investors are actually taking a lot of factor bets, which typically is very difficult to do consistently, and I think that shows in their results. That's one of the reasons why their returns are probably lower. So what happens when you start combining data science with artificial intelligence and managing money? Well, we don't have a lot of data, but this is something I noticed recently in the news. It was published in Eureka Hedge, and I think the title of the article was something like, the artificial intelligence hedge funds are beating their human masters or something. But the reality is that's not really fair. Whether you're using artificial intelligence or not, it's still people doing the work. And it still takes somebody who's trained on how to use the tool to come up with the idea and to figure out which experiments to run and which questions to answer. But what we see here is it looks like people who are using newer technology, more data science, are outperforming the traditional systematic people who are maybe just using a regular OLS regression and more standard data sets. The machine learning people tend to be using alternative data sets and newer techniques. And we see that they don't actually have any additional exposure. In fact, they seem to weather big shocks quite well compared to their competitors. So in conclusion, I would say that systematic hedge funds are outperforming, or at least appear to be so far. The markets are very difficult and unforgiving. Being in the hedge fund space is definitely something that teaches you every day that you can't predict what's going to happen next. But definitely machine learning and regularization techniques can help us detect alpha better, and they can speed up the process of creating new ideas. And together with Cloudquant, we think that data scientists like yourselves can be exposed to new data sets and generate more investment ideas for the future so that we can essentially hope that if we look at this graph back here, we can hope that that's what the future the future hedge fund index looks like is up and to the right, much smoother returns because we're doing things more efficiently and we're using new tools that weren't available before. And I think I've got just a couple of minutes. I'll open up for questions if that's all right.
Yeah, we've got some time for questions for Morgan.
Hey, so I have a couple questions. The first one was the graphs that you showed were really interesting. Had you run those over a longer time period? Because you chose a particular period where the market had a massive run-up, right? We were seeing double-digit 13, 32% returns year over year from basically 2012 forward, with the exception of like 15, right?
Yeah, I totally agree. That's the data that we could easily find. Usually you have to subscribe to a database, which we don't. And so we pulled that off of HFR, and they only went back to 2011. Great point. Absolutely a bit of a bias to the data set. It wasn't intentional. It was just what was available. And but I think over longer time periods, what I'll tell you is, when I was at the hedge fund that was had $2 billion under management in 1997, and they had a 30% annual compound rate of return, or 18% annual compound rate of return over 30 years, they don't today. Their returns are better than what we saw with the index, but not a lot better.
Sure.
So.
My second question has to do with how do you balance democratizing a trade or a search for a trade with overcrowding in that trade? So are you getting people who come onto your platform, discover a strategy, and then either sell it to you and then go license it or trade it themselves? Do you have any issues with that sort of open source nature in a traditionally closed off system?
Well, our goal is to enter into a relationship where we would operate the strategy and we would take care of the trade execution, because trade execution, dealing with the market microstructure and its complexities, is a whole nother topic, which I just totally glossed over today, and it's a full-time job to do that. We want to create an easy button for data scientists to focus on prediction, and we'd like to take the other roles in the algorithmic trading value chain and manage those ourselves, because we've been doing that for years, and it's just, it's something that would be very difficult to have a person who's not a Wall Street person understand that problem. So we try and distill it down to a prediction problem, and we just really want to come up with as many unique ideas as we can, so the more the merrier. So.
Great, thanks.
Just out of curiosity, is it just equity, or do you guys do options and FX?
I couldn't tell exactly what you said, but I think you're asking about options and FX?
Yeah, I was just wondering if you guys do those, or is it limited to equity?
Well, we're startups, so we dream about having options and FX on our platform, but we don't support that yet. But it's definitely an interesting area for us that we're keeping an eye on. So.
We have a question right here.
Yeah, so I'm aware of a similar website called Quantopian. So I don't know if you can contrast your offering versus what's offered by Quantopian.
Sure. So Cloudquant is the first platform to have high-resolution data available for free. And so, we have the ability to simulate execution costs very precisely, and we spend a lot of time trying to dial that into actual trading performance. A lot of times, if you don't do that, you're dealing with approximations. I'm trying to find. Here we go. You're dealing with approximations that aren't going to be very accurate, so you're going to come up with a lot of answers that are really just chasing ghosts. There's strategies you can't trade that exist because of market friction, and you've made some measurement error in your transaction costs. So we're trying to be as precise as possible to where we take into account the microstructure, the exchange fees, and all the different things that have to do with execution as precisely as possible with no approximations if possible.
So two questions. One is, what kind of additional data would a person have access to if they join your service? And then second, are you US only, or is it trading equities around the world?
At the moment, we're all US equities and ETFs. We're adding new data sets. We have earnings data sets. We have that tell you when earnings dates are. We have data sets that have some fundamental data. We're currently in the process of looking at adding new sentiment data. And whoever is a free user on the platform, they'd have access to utilize the same data sets that we have internally. They'll be available as we add them. So no restrictions from our perspective.
We've got time for one more question.
Hi.
Hi.
So with the passive SPY strategy that you had up there before that was kind of beating everything, does your platform, Cloudquant, support leveraged ETFs like the 3X on the SPY, which, by the way, Quantopian does not?
That's a great question. Already getting good ideas. So we do support trading all US ETFs. And maybe afterwards we can talk about that. But we're not really here to give investment advice, so I just want to point that out. But it was just an interesting study.
All right, thanks very much, Morgan. Appreciate the talk.